Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide divorce mediation and valuation services in St. Louis, Missouri. Today, we'll discuss valuations for financial reporting with Mark Zyla. Mark is a valuation expert in Georgia, the managing director of Zyla Valuation Advisors, which is an Atlanta valuation and litigation consulting firm. Mark is also the chairman of the Standards Review Board for the International Valuation Standards Council. He also was the primary author of the education program of the AICPA and the Royal Institute of Chartered Surveyors for the Certified in Entity and Intangible Asset credential. This is the CEIV, which I believe most valuation professionals are aware of, that goes towards certifying valuation experts in valuation for financial reporting purposes. And it's a fairly new credential. Another area that people, I think, kind of understand is if you've done valuations, right, is fair market value.
Mm-hmm.
Okay. And that's the value for a willing buyer, willing seller. But in this, there's actually a concept called fair value. And so how is that different? What does it mean? Is it even important?
Yeah, it's important because it's the standard that's outlined in the accounting standards, ASC 820. And it's when the FASB created the concept of business combinations and accounting for business combinations and identifying the intangible assets and goodwill, residual goodwill, they created a new definition of fair value. So that's how the valuation expert will look at measuring fair value. And one of the distinctive features of fair value within the definition is it's from a market participant standpoint. Mm-hmm. So it's known as an exit notion, not an entrance notion. So it's interesting that to measure fair value, you measure it what the asset can be sold for, not necessarily what you paid for it. So what you paid for it may not necessarily be fair value. It could be, but it may not. So it's important to follow that fair value standard. At the end of the day, compared to fair market value, the concepts are somewhat similar, but the approach is different in how you get to fair value in financial reporting versus fair market value for tax purposes.
And most people may understand, like if they look back at their financials, they may understand book value. Mm-hmm. So is fair value the same as book value?
No, it's different. So book value typically is historical cost of assets that are either amortized or depreciated over time. Fair value is what you could sell those individual assets for in the marketplace as of the measurement date. So it might, and it maybe include assets that in a business combination that typically aren't put on the books. So, the intangible assets that we were speaking about earlier, typically internally generated intangible assets don't show up on the acquirer's balance sheet, but just the acquired intangible assets show up.
Well, and that's kind of where you come in and other valuation professionals come in, because if it were just what was on the books, and I think that, people kind of throw around book value and these types of things, but essentially something could have been bought 20 years ago. It could have been fully depreciated. It could have been written off. And so when you're coming in, you're trying to really see what is the value that somebody else would buy this for, not because you bought it 20 years ago for $3 and now it's worth $1 million. Like we're trying to build in what is that difference and how do you calculate it?